Welcome back. Let's talk business now. Equity Bank Group Holdings has reported a 14% rise in their first year pre-tax profit to 35.2 billion Kenyan shillings amid sustained growth in customer deposits. Now, with fluctuations in interest rates, the lender now projects a slow loan uptake in the second half of this year. Jimmy Mbogo tells us more.
Equity Bank's half-year performance has seen the lender increase their loan loss provision 89% as the lender prepares for increased default in the wake of increasing interest rates. Now, according to Equity Bank Group CEO Dr. James Mwangi, interest fluctuations globally have necessitated the proactive move to cushion depositors from any loss, even as the bank defended its move to increase interest, saying it is due to the operating environment.
If you look, our interest expense is growing at 54%, and our interest income is only growing at 27%. So when people see us increasing rates, we're not increasing rates to grow profits, we're increasing rates to pass over the cost of depositors to the borrowers. That instability is likely to hold for some time because inflation has stubbornly refused to come down.
His sentiments come in despite a growth in the bank's interest income, which grew by 27%. Dr. Mwangi has further welcomed the move by the government to shift its borrowing from the domestic market to the external market, saying the move will see lenders increase the credit issue to the real economy and spur economic growth.
Burden is being taken to the borrowers. If you look in Kenya, the government is now offering 16 and 17% for 3-year bonds, and the government is now competing with the banks. So banks are offering similar interest rates to retain the deposit. As a result, that cost is being passed to the borrowers. And we have seen lately that interest rates are now averaging 18%.
By the end of the first half of the year, the lender's net loan loss provision rose 26% to stand at 817.2 billion shillings, while the net interest income increased 17% to 46.4 billion shillings, while the group's assets crossed the 1.5 trillion shillings mark to hit a 1.65 trillion shillings, a 23% growth compared to 1.3 trillion shillings similar period last year. At the same time, the lender has revealed that subsidiary contribution has significantly increased to stand at 46%, even as the bank now projects that DRC could overtake the Kenyan bank by 2027, while projecting that the insurance business will outperform the banking business by the year 2030. Jimmy Mbogo, KTN News.
Moving on, the government intends to reduce the pass-through cost of electricity